Welcome back to our second panel. On our first panel, we heard a spirited discussion of the Dodd-Frank Act and the state of financial regulation. For this panel, we're going to focus on what should be done to improve the U.S. financial system. For this discussion, we have another fantastic panel. We have with us Kathy Kraninger, who is the former director of the Consumer Financial Protection Agency, Tyler Beck-Goodsby, who is the Klein-Heinz Fellow at the Hoover Institution at Stanford University and is a former acting chair of the Council of Economic Advisors, and Randy Gwynn, who is a partner at Davis Polk, where he is the chair of the Financial Services Group, and Aaron Klein, who is the senior fellow at the Brookings Institution and is a former deputy assistant secretary for economic policy at the Treasury Department. Thank you, everyone, for being here today. It's good to see everyone. Why don't I start off with a question for Randy, which is, the core of financial regulation really is bank regulation. And since the 2008 financial crisis, and especially with the passage of Dodd-Frank, as we just heard, we've seen Congress and regulators adopt a wide variety of new regulations covering nearly every aspect of a bank's operations. This leads to the question, is bank regulation really inevitably evolving to treat banks as utilities, where federal regulators determine which products they sell, the prices they charge, and even how much profit they can earn? And if so, is this quasi-utility-like or formal utility-style regulation the only real way to regulate banks and prevent future financial crises? Or is there a better way?
So let me start by answering that. Fortunately, I don't think the dystopia that you've described is actually come to pass, at least so far. My own personal view is that the banks are best regulated by focusing on capital liquidity requirements, possibly resolution planning, and to some extent margin requirements or collateral requirements, and focusing on transactions with affiliates. A lot of the other regulation may or may not, the benefits of it may or may not exceed the costs. I think Aaron won't be surprised to learn that I think that the Volcker rules costs outweigh its benefits. Very complicated to apply, very much in sort of the micromanagement area that you're talking about, Andrew. But I think that, fortunately, I think the regulators have focused mainly on capital liquidity, and that's where they should focus. And I hope that's where the focus continues going forward. I guess one other thing, though, is that you mentioned that the Dodd-Frank Act sort of expanded bank regulation to all sorts of financial institution models. I think that's true, and I think that's not necessarily desirable. It's the people felt comfortable with the bank regulations, so then it then is adapted to insurance companies and fintechs and other companies doing financial services. I'm not sure that that's right, and whether we shouldn't be thinking about new regulations that fit the particular business model as opposed to trying to shoehorn new business models into old regulations.
Aaron, what's your take? Have we overdone regulation for let's starting off with our banks? Do you think we've got the right balance right now?
Look, I think the debate is based on the wrong sets of concepts. I think we've been debating this pendulum of more versus less, as opposed to smarter. So, for example, our anti-money laundering laws and regulations are insane. They impose giant costs. They are the things that are really hurting smaller financial institutions. And frankly, they hurt all of us in slowing down emergency lending and emergency funds in the COVID pandemic through PPP. But somehow this AML regulatory burden, which is giant, more costly than Dodd-Frank ongoing implementation for the vast number of banks in America, is kind of on autopilot or separated from this broader conversation about bank regulation. Then there are other areas where I think we don't have enough regulation, where there are products and practices. Nobody's really regulating the credit bureaus, for example, and their system, the ability of a consumer. A consumer has zero recourse if there's an error on their credit to ultimately get that dispute solved factually. They can go into a "do you believe I owe you money?" but there's no adjudication, which helps explain why, as many as 1 in 5 Americans have a material error on their credit report. If there's an Aaron Klein in New Jersey who didn't pay his AT&T cell phone bill, I'm talking to you. But more broadly speaking, right, this messes up our entire credit allocation system, which in the aggregate may work out, but for the individual is deeply unfair. So Andrew, to answer your question specifically, I think rather than getting to this question of more or less, the answer is, where can we eliminate dumb, which exists in quite a bit of space, and where can we target on the area where, in point of fact, people are left vulnerable and you have systems that aren't working properly?
Well, Aaron, you make a great point on AML, and one of the reasons you're here is I knew you would bring up these issues that really need to be injected as part of this debate, and I think that's, I'm going to come back to that. But let me move to Kathy, though, to follow up on your remarks, though, about where regulation is potentially needed. And it seems like most of the debate really is in the consumer space. And there's probably not an area where there's been more debate over the last decade than consumer financial protection, including from the structure of the agency to the nature. You know, Kathy, as you know, the Bureau has been subject to a lot of criticism and debate about whether or not it should take a position of facilitating consumers' own decision-making or being too paternalistic in helping them make those decisions or really enhancing their rights. What's your view, you know, having been there now and led the Bureau, is there a sensible way forward on consumer protection that works for consumers, works for institutions, and actually can build some consensus around consumer protection regulation going forward?
That's a great question. I'm going to pick up also where Aaron left off, because you found some definite agreement, at least for me. I won't speak for everyone. The framing of more or less is really unfortunate framing. And that certainly was painted on me and others at the CFPB, that is the dynamic in play. And it's not. It's actually about being smarter. And I think a lot of that goes back to the origin of the CFPB. Certainly Democrats claim the mantle that, you know, they're the ones that are for consumer protection. And Republicans, frustrated, as the last panel talked a little bit about, with respect to a lot of the government oversight and lack of accountability that was built into Dodd-Frank for the Bureau, for reasons, you know, as I said, the Democrats argue is good for consumer protection. Republicans were painted as not caring about consumers. And so the notion that there might be different approaches that can be brought to bear to regulation here was kind of lost in this, you know, do you or don't you care about stark comparison of consumers in the marketplace. So I do believe, you know, the CFPB has an important role. Congress laid it out very clearly. Both parties can get behind and have gotten behind the ability of this agency to regulate the consumer finance space in a way that is actually going to empower consumers. And that's something that, you know, we sought to do. I certainly hope going forward the Bureau thinks about. And one area where that's particularly, we talked a bit about it during the time, but cost benefit analysis. It got a bit of a bad rap, but the notion here is not that you're going to find a hard dollar amount that you can put against every benefit, or a hard dollar amount that you can put against every cost, that it has to be monetized or quantified in that way. The discipline of actually articulating the costs and benefits, the discipline of going through the process and thinking through unintended consequences. I think that's something that we tried to bring to the Bureau. That's something I hope that the Bureau continues to take seriously. And I know we'll talk a little bit more about structure and talk about at least some of the specific areas of reform, like 1033, which I do think is going to be huge for consumers in the marketplace generally, and very empowering.
Well, talk a little bit more about that then, just as an area of reform. You know, what do you see as the real prospect there?
So as was noted, the Bureau put out an advance notice of proposed rulemaking on Section 1033, you know, how consumers can have enable third parties to access their own consumer information. Aaron mentioned, frankly, the credit bureaus, and I will say I don't know that they'd agree that they're not regulated. I'd say the CFPB has done a lot of work in this space to try to work with the credit bureaus. But the data into the system, of course, is and the system itself is only as good as the data that comes into it from lenders and from others. So there are definitely some challenges with credit bureaus and the legacy system that they have, extensive regulation, frankly, at the CFPB and the FTC. But I think we are clearly seeing consumers' desires and interests, lenders bringing other information into the system, the use of that data, and frankly, the control that I, as a consumer, would like to have over my own information. All of those things are definitely changing consumer expectations. And 1033 and the Bureau looking at this is hopefully a way to catapult that. It is a highly complex issue. There's no doubt about it. That has the potential of turning the underwriting, the current credit bureau system and really the underwriting regimes that so many institutions rely on, turning that upside down. So I think that is a topic that is pretty deep and wide. But I think the ANPR was a great start there. A lot of nuance that was built into every question, and also lots of thoughtful responses that have come back in. So this is an area where the Bureau really can stake out its claim for this responsibility in an area that really has not been touched by federal regulation.
And Tyler, what I want to move to you is, you're the economic historian on this panel, and maybe it might be helpful for you to kind of talk about, how the U.S. system actually compares internationally. We've heard a lot on the prior panel about how many agencies the federal U.S. system has. The alphabet soup of regulators, as it was referred to, and the diversity of institutions we have. How do we compare internationally, and what does that tell us about where potential reforms might be appropriate?
So it's an interesting question, and I think it's actually possible to go back pretty far. So in the past 160 years, the United States has experienced no fewer than 12 banking crises. And during that same period, so since 1840, does anyone want to guess how many banking crises our neighbor to the north, Canada, has experienced? I mean, this is a similar economy, similar legal tradition, similar levels of per capita income, similar level of banking. Zero. Canada has not had a single banking crisis in the past 160 years. And this actually isn't an anomaly. I mean, across countries, we observe a lot of variation in the frequency and severity of banking crises. And even within countries across time, we see a lot of variation. So England, not Scotland, but just England, had 6 major banking crises from the establishment of the Bank of England through 1847. From 1847 until the run on Northern Rock, they didn't have one, not even during the Great Depression. Depends a little bit on how you define a crisis, but a lot of variation there. And this is despite the fact that across countries and across time, the basic contracting structure in banking is actually remarkably constant. So why have we been so prone to banking crises here in the U.S.? I would contend that the original sin in U.S. banking, and the effects of which we are very much still living with, is that for most of U.S. history, in most U.S. states, right up through the 1970s, not only were banks not allowed to branch across state lines, they weren't even allowed to branch within a state. And this created a highly fragmented, highly fragile system of literally tens of thousands of small, undercapitalized banks with very little opportunity for portfolio diversification and very high exposure to local real estate. And even though it's now been 30 plus years since banks have been allowed to branch here, we're very much still living with the legacy of this original sin. So, I mean, we see it, for example, in that balkanization of U.S. financial regulation to which you referred. So with the typical U.S. bank subject to a patchwork of regulators at the state and federal levels, in contrast to a much more integrated approach in Canada. And the second legacy is the legacy of over 150 years of policy interventions to try to prop up a fundamentally fragile banking system, most notably through subsidizing overinvestment in residential real estate in order to prop up a banking system that historically was so inextricably entwined with local real estate markets. And just to take one example, in Canada, mortgage interest isn't tax deductible. So from this perspective, the 2017 2017 Tax Cuts and Jobs Act was, I think, a step in the right direction, but there's still considerable way to go.
So, Randy, I'll return to you then. The United States does have a very different system, as Tyler makes out, and as you were pointing out in your remarks, we have a lot of non-bank entities that are outside the safety net that a lot of other countries don't have the same degree of. What's your thought about how we address, where we draw that line on that safety net? The FSOC was created under Dodd-Frank to potentially designate entities for enhanced supervision by the Federal Reserve. Do we need to have a more active FSOC here? Do we have to kind of go back to the drawing board and start having more federal regulation of non-banks? What's your view? What's the way forward here?
Well, I think I think one of the reasons Canada, at least, I don't know about the UK, but I think one of the reasons the Canadian banks fared better during the Great Depression and at least in the Great Depression, is that they were diversified across Canada as opposed to being unit banks in certain localities. I don't know. I don't think that's necessarily the same reason why they fared better in 2008, because it's basically a small number of very large banks in Canada that, it's a little less competitive than it is here in the United States. I think as far as how to regulate, I think what you're asking me is, how to regulate what is sometimes colloquially referred to as the shadow banking system. And I think that's a tough one. I mean, I think that we're moving toward a notion, I think around the world, but especially in the United States, of same activity, same regulation. And I think you hear that from a lot of different people. I mean, I do actually think that the shift of FSOC from designating systemically important institutions to focusing on systemically important activities is probably a good one. I don't know whether it will shift back. I think that the Yellen Treasury will continue focusing on activities. Whether they start designating institutions as systemically important, I don't know. I do think that when someone is designated systemically important, there is a risk that they need to be sort of protected from failure, and I think that's a mistake. I think we've moved in the direction of making sure that the losses of banks and non-banks will fall on private shareholders and not on the taxpayer, and I think that's a good development. And but again, I guess getting back to your original point, I don't think that means that the government needs to micromanage, but I do think that there probably needs to be, rethinking about, what entities are subject to capital liquidity requirements, what their balance sheets look like. Do they have short-term funding and illiquid assets, or are they, like a bank, or do they have different balance sheets? And I think depending on that, or depending on where they're going, should affect what sort of regulation is applicable to them. But I also just agree with what Aaron said, which is we've really got to look at our evolving financial system and try to figure out how to regulate smart and not just a lot. And I think I worry a little bit that we have statutes that were passed in the early part of the 20th century, mid 20th century, that don't really fit the evolving financial system. And I don't know if there's really an ability to go back and review those, but I think applying them with some sort of flexibility, I think, is important.
Well, so one of the issues that came up in our last panel was how Dodd-Frank in many ways looks to be very reactive instead of prospective in the way it's approached regulation, particularly because of the developments in fintech, AI, digital currencies. And so maybe, Aaron, you've written a little bit about this. Going forward, how does the regulatory system need to adapt to account for all this really remarkable innovation? It looks like Dodd-Frank just didn't see around the corner enough to see this coming. So what's your view? Or do you think that Dodd-Frank made the financial regulatory system flexible enough to incorporate it, appropriately regulate it, and allow it to flourish in a responsible manner?
So Andrew, I think actually Dodd-Frank set up a great framework, but the test, like any regulatory framework, you can't legislate judgment. You can't legislate opinions or actions or wisdom. You can legislate structure. And by creating the Bureau and separating out consumer issues from the Federal Reserve, and I know technically speaking, the bureau structure is a little bit different, and you know, that I think Congress didn't go far enough in separating it, giving it its own.
We'll come back to that. We'll come back to that.
We'll come back, but just
Yep.
state for the argument, right? We separate out the bureau. We gave it authority, somewhat analogous to kind of what Randy was talking about, which was to go after similar activity.
Mm-hmm.
Now, Tyler makes a very good point, and I would add on to that the historical point of view, which is that we have no national money transmitting license, right? The transmission of money is a state-regulated entity without national licensing. And what technology is really done when you get down to it is technology is unbundling banking. And by unbundling banking, you're allowing activities that we assume were part of banking to occur outside of the banking system and outside of chartered banks. You can look at the Chime case that just came down in California, where part of the settlement was Chime can't call itself chimebank.com. They had to they had to go to court, regulatory court at least over that. But if you think about it more broadly, right? When you get down to the core of our banking system, and this isn't Dodd-Frank, this is well predates it, banks are defined by taking deposits and making loans. Payments, not part of the banking system legally in the separation of banking and commerce, right? It just happens to be part of the banking system because they've had a comparative advantage in doing it. The same with credit allocation, right? Nobody thinks a mortgage broker, right? We figured out how to do mortgages largely outside of the banking system. This gets into a lot of the cause of the financial crisis. Car dealership loans, another thing that's, you know, somewhat been carved out, right? I can get a loan for a car, but somehow it's different if that same loan came from my bank branch floor or the auto dealer showroom floor. And I just want to get back to one point that you were talking about with FSOC, which I think interrelates to this, right? Mm-hmm. FSOC is modeled, to my opinion, on Star Wars. It's the Jedi Council, right? Well, what did I learn from watching Star Wars? Number one, the Jedi Council failed, right? The evil emperor was right in front of their face the entire time, and the wisdom of all the council sitting around meditating, right? Even with Yoda himself, they couldn't figure out the threat until it had been destroyed. So let's look at this. Two things about the FSOC. Number one, probably the biggest champions of the FSOC would have pointed to their money market mutual fund rule, enforcing the SEC to do some new regulations on money market mutual funds, right? And unsticking what they thought was a stuck process. Well, what happened with money market mutual funds? The very next crisis, 3 seconds into it, bailout city, right? Over the laws that were passed that precluded the exchange stabilization fund, right? This wasn't, liberal bailouts, right? I mean, this was the Trump administration and the Federal Reserve running to bail funds. There is no legal structure. And by the way, Congress afterwards went back and blessed it, even when that money was taken out for a prohibited legal expense. So you talk about the limitations of Dodd-Frank. It doesn't matter what structure you legislate when the people in charge panic.
So Tyler, what do you think about in terms of looking forward then, how to make whether or not our system is appropriately balanced to incorporate all these new innovations? How do we compare, first of all, other countries? And do you think you're out in California now, and kind of the epicenter for a lot of this fintech revolution? Do you think our regulatory structure is appropriate?
Well, I mean, I think one of the important margins along which innovation occurs is not just the diffusion of new technology to existing firms, but also the entry to market of new firms.
Yeah.
And so one of the strengths of the U.S. financial markets is that, by and large, young firms here are able to rely upon a more diverse set of institutions for early stage financing than their counterparts in, say, Europe. But commercial and industrial lending by banking institutions is still a very important part of that ecosystem, particularly for firms that lack alternative sources of finance. And I think here we observe some effects of Dodd-Frank and the regulatory apparatus of Dodd-Frank in that it appears to have been resulted in a reduction in the supply of lending to small and medium-sized enterprises. So there's actually been a lot of recent research that's found that Dodd-Frank effectively raised the fixed costs of credit intermediation, which disproportionately impacted smaller banking institutions for whom commercial and industrial lending to small and medium-sized enterprises simply accounts for a greater share of their loan portfolios. And this effect operates through multiple channels. I mean, first, there's any increase in the fixed cost of loan origination raises the average cost of extending a loan, and that effect is relatively bigger for smaller banks than for larger banks because they have a smaller loan volume over which to average those increased fixed costs. And the smaller the loan, the bigger the reduction in margin. And the second channel is increased consolidation. So you're reducing the supply of lending to SMEs by reducing the prevalence of banking institutions that account for a disproportionate share of that lending. And then finally, there's a third channel in that institutions most affected by Dodd-Frank stress tests tend to reallocate lending away from smaller firms to which higher risk assessments apply and toward larger, more established firms. And on the one hand, that was probably part of the design. It makes individual banks safer. And since Dodd-Frank, there's a lot of evidence that the banks which perform poorly in stress tests tend to adjust their portfolios in ways that make them more closely resemble banks that perform well. So if you're looking at this from a microprudential perspective, individual banks are becoming or have become safer. But if you're looking at it from a macroprudential perspective, the fact that bank portfolios are becoming more similar means that the system as a whole is potentially more risky because you've increased portfolio concentration for the system as a whole. So any regulatory failure, for example, misspecifying the risk weights, that's going to be multiplied across the entire financial architecture. And one thing we learned from 2008, 2009, and the European sovereign debt crisis is that an asset is relatively risk-free until it's not. And so here, I think the 2018 Economic Growth, Regulatory Relief, and Consumer Protection Act offers perhaps some template or an important step toward moving beyond a one-size-fits-all approach to financial regulation to make sure we're not losing valuable portfolio diversification, but still preserving the discretion on the part of financial regulators to intervene where necessary.
So, Randy, I'm curious your thoughts on that. Do we have tailoring down correctly now? Congress came in specifically to try and provide the Fed with more guidance and authority to tailor regulation based on the size and risk profile of the institutions. Do we have the right balance now?
So I think a lot of progress has been made in tailoring the capital requirements, in particular, and to some extent liquidity, to size and complexity and risk. But I actually think that Tyler has a good point, which is because, for instance, in stress testing, there is the mysterious black box Fed model that decides, whether your own stress testing is correct or not, and whether you can make distributions. It tends to move people towards sort of I think they want to avoid this, but it creates sort of a mono model where banks have an incentive to adjust their activities to be the ones that are going to be succeeding with the Fed's model. And so that leads them in a direction of having correlated assets and liabilities, which is exactly what you don't want in a crisis situation, because if one fails, then a whole bunch fail at once.
The Lemmings problem. Everybody goes over that stuff together. So it's still some work to do then, it sounds. Let's talk about kind of maybe the biggest debate in financial regulation right now. I'll turn to Kathy, which is the structure of the CFPB and the governance. From the day one that was introduced, there has been a sharp partisan debate. I think my view, which is very much driven based on the party's kind of intellectual positions. One has kind of a Wilsonian progressive view that has a lot of belief in independent agencies and less belief in kind of Congress and the executive branch overall. And the other side, which has a much more strong belief in kind of using constitutional authorities, Congress and the executive branch, to implement financial regulation. Supreme Court recently came down and said that the CFPB provisions provisions in Dodd-Frank that restricted the president's ability to remove the director were unconstitutional. Kathy, now there's nobody better to ask this question to is, having been there now, what's your thought about the structure? Should it be accountable to the president? Should it be subject to appropriations? Do you think either of those reforms would actually adversely impact the ability of the Bureau to do it, complete its mission? Would they enhance its ability to do its mission? What's your view?
So, look, being in that seat as director of the CFPB, particularly prior to the decision in Saylor Law, and even my position that the agency took in that litigation, it is an incredibly powerful position. There is great responsibility, and there is no, limiting principle with respect to the power of that director. And that's really the fundamental issue. Is that an enjoyable job for someone who at least has a self-limiting principle? Yes, it was. There's a lot of independence. There was a lot of opportunity to do very innovative and cool things with respect to the way you should manage in government. There are strings associated with the accountability we're talking about. I was an appropriations staffer for part of my career. So yes, when you're in an executive agency that's appropriated, you are hampered. The notion that you're going to have continuing resolutions and government shutdowns and other things, that is certainly limiting. And those are not limitations that the CFPB needs to be concerned with. At the same time, though, and I certainly align myself with the philosophy that you just outlined, Andrew, I believe that the Constitution created 3 branches of government and that there is a benefit to the unitary executive, precisely the way Aaron noted it. I mean, I will say the CFPB has a vertical, and there's a lot of power in that vertical. But the things that can happen to the sides of the CFPB that go in an opposite direction or send mixed signals to the marketplace or reverse, in some cases, a protection that the CFPB might think is important, that is not good for consumers. I actually do believe that consistency and that stability that we're seeking from regulators is important for consumers. The experimentation can happen at the state levels. It does, and we'll talk a little bit about that too, and folks have brought that up. But I do believe there need to be greater limits on the CFPB's autonomy, frankly, and it gets to the larger question on independent agencies generally. I don't know that, frankly, even just appropriations alone, just Saylor Law alone, is enough to address what I think are some fundamental issues around independent agencies. But I'd also note that that might not be anything that changes anytime soon. And I definitely see that Aaron wants to weigh in on this, and I would love to hear what he has to say.
So I will turn it over to Aaron. And now, Aaron, I will note that you have written about the Bureau and defended its current structure pretty vociferously. But one thing you've kind of continued to note, I know in your writings, is that it should be apolitical. I'm curious to know, what do you actually mean by that? Because we've seen, the Bureau's charge has been a very political thing. Congress has been very involved on both sides, and that's kind of part of the electoral process. You've also seen somebody who had previously run for office and who then subsequently went off and ran for office be the head of it. Right, so it seems like politics on both sides of the aisle have been inherently part of the Bureau. When you talk about getting the politics out of the Bureau, walk me through, what do you actually think needs to be done?
So let me start with something, which is to congratulate the Federalist Society. You guys have made up a complete principle about a single head versus a board of directors, right? It appears nowhere in the Constitution, appears nowhere in any of the Federalist Papers that should we create an agency that's headed by one person versus a committee, and one group is okay and what isn't. And you've unleashed it with the Bureau, and it's about to go and bite the director of the FHFA, whose model was passed along the very similar lines, passed, with, as Andrew well knows, the legislative history of that under President Bush. Then we'll get to turn to the comptroller of the currency, passed under my favorite Republican president, Abraham Lincoln, right? Which also created a single person who is off of congressional appropriations, who can deliver testimony outside of OMB. And then let's go through and get rid of the Fed, because it's all the same principle. Trump should have been able to fire Jay Powell, right? I mean, what were the governing structures there? The Fed has far more authority, with all due respect to Kathy and the Bureau, right? The Federal Reserve. And what the heck are these 12 independent regional banks doing, who are completely independent of the government, but given the governmental authority? This principle, if fully unleashed and intellectually followed in a consistent manner, is a radical rethink of the government structure we've developed. Whether that's better or worse, whether we run into the problem now of having 4 branches of government with the Federal Reserve as the 4th, those are fair intellectual questions, but it is a radically different outcome unleashed by this invented concept of a single agency head versus a multi-member. And is it 3 members that are different? 5, 7, right? We have examples all through government of different sized boards. As it relates to the politics of it, I think, I'm not sure I ever used the word apolitical, and certainly former elected political people, my colleague at Brookings, friend, and I think one of the great Federal Reserve chairmen in recent history, Ben Bernanke, was the chief economist to President Bush and a local elected official in Princeton, New Jersey. And I think that local when at various points, I think Chairman Bernanke is referenced serving on that local elected official capacity in the school board, actually helped him navigate government service in a way that gave him a set of skills that are very valuable. So I don't think there's anything wrong with having people who've run for office, elected or not. I think Neil Kashkari is doing a great job in the Minneapolis Fed.
So then, when you talk about making it depoliticizing it, what do you refer to then?
What I'm referring to there is the fact that we should all want a system that works. The failure of an agency, right, whether you were for or against it at birth, you should want something, once we've committed to that, to work. We shouldn't be rooting for failure, right? And for an agency to work, you have to be structured to make it work. There's an ideology that you want government to undermine public confidence in government. You want government to fail the people. And I think that's an extremely dangerous ideology, particularly for those in charge of government. Now, we can have differing views as to what role government agencies should play, right? And we should all obey, regardless of our own personal views, that perspective. But trying to undermine the success of an agency to prove a point, I think, is incredibly dangerous and problematic. And that is what I mean. Further, we've agreed through a set of reforms to the civil service that we're going to have at some level a hybrid government, very different than the United Kingdom, which I know Tyler's talked about before, where you're going to have one level of political actors and one level of career continuity actors. And not every part of government shares that, right? The White House is almost all political appointees. Differing agencies are different. Main Treasury is pretty heavily political. The IRS is pretty heavily career, right? There are good reasons for that distinction. And so when I talk about that, what I'm trying to find is what's the right balance within each agency, and it depends on its mission. We've decided as a society collectively that financial regulators should err towards the more independent side, the more career-dominated side. We may have gone too far in that. There are legitimate arguments to be said that the Federal Reserve doesn't reflect the will of its governors as much as it does its staff, and we need to address that. There's some equally legitimate points that argue when agencies get too politicized, they get gridlocked. A lot of people talk and point to the SEC as an example of that. But we should all want all of the agencies to succeed in their statutory missions and objectives. And if we disagree with those, the proper forum to take that up with is the legislative forum and to change the statutes or the mission of the organization.
So we're going to turn to Randy, our resident Supreme Court clerk here, just to get his take, and also just more on, you've been involved in bank regulation for a long time here. What insights do you have about what structure, and do you have any views about which ones matter, or what really makes the difference between an agency being effective? Is it the people, or is it structure, or both?
So I think it has more to do with the people than the structure myself. I I've often wondered whether a single director versus a commission where the chairperson of the commission has almost autonomy, whether that really makes a lot of difference. I mean, if you look at some of the multi-member boards or commissions, the chair really sets the agenda, has the eyes and ears of the staff, and the other members really have very lean staffs. And so I do wonder the difference. I guess the one thing that I will say here, since you mentioned the Supreme Court, is I think I agree with Kathy. I think, and with Aaron as well, is I'm predicting here that the Supreme Court will in fact hold that the single member FHFA violates the Constitution for the same reasons that the single member CFPB did, and they'll probably say that the remedy is that the director will be removable at will by the president. I think they actually hired Aaron Nielsen, who did a sort of an admirable job trying to distinguish the FHFA director from the CFPB director by saying that it was more like a cookbook to implement policy at the FHFA. I didn't find that terribly persuasive. I think the FHFA director has a lot of discretion, maybe not as much as the CFPB director, but a lot of discretion. So it'll be interesting to see how the court actually comes out on that. And it'll also be interesting to see whether they reach the merits and how they rule on the merits in Collins versus Mnuchin. But I think the constitutional structure question is an interesting one. And I do think it's debatable about what the real difference is between a single member. I guess the bottom line, I tend in favor of more political accountability and therefore, in general, toward the president the agencies having more accountability to the president than last.
Yeah, no, I think it's a fascinating question, and having myself served on both sides of Pennsylvania Avenue, I can tell that a little bit depends on where you sit. You can certainly see when you're in the executive branch the value of having a single director for speed and efficiency and effectiveness. When you're in Congress, though, it is, and really you're in the minority, it is nice to have commissioners who are on your side of the aisle to understand what's going on. So there's a real, I think, interesting tension there, of which Congress and actually the executive branch have to figure out as they when they think about reforms in the future. Let's move on to another area, maybe one of the other hot button issues, thinking going forward, which is the extent of the safety net. Tyler, again, I'll only go to you as our economist. Has the federal government's safety net gotten too big? Like, do we have too many types of entities now that can rely on federal assistance in a crisis? You know, certainly banks have always, at least for 80 years, have been subject to have deposit insurance and had that federal backstop because of the unique nature of banking, and that's seemed to have worked reasonably well for a long time now. But we've seen over the last decade that creeping safety net. Is that a good thing for our system? Is it something we should learn to embrace and just accept as part of financial regulation going forward? Or does that create risks for future financial crises? What's your view?
Well, I mean, that is the big question, I think. So first of all, I mean, getting any form of insurance pricing to be actuarially fair is very difficult. I think the FDIC does a much better job than a lot of other entities. And part of the structure of the design of the FDIC is the notion that smaller depositors are going to be less well informed about the solvency of financial institutions than larger depositors. So you want to protect the small depositors while also having the market discipline of those of preemptive withdrawals from unsafe financial institutions by larger and presumably better informed depositors and creditors. But in a lot of the federal government, we have obviously not explicit guarantees of bank liabilities, but implicit guarantees of bank liabilities, and it is very hard to get that pricing actuarially fair. Because there is, in many instances, there is no pricing of that.
But Tyler, is this a case though of where, like, sometimes doing anything worth doing is worth doing badly? Like, even though when it's mispriced, the benefits still could outweigh the cost of that, of getting the price slightly wrong? Or what's the consequences of that?
I mean, I think the consequence is that you get uncompensated risk shifting by bank managers who enjoy some information asymmetry. So they shift risk to either bank creditors, or they shift risk to bank creditors, but in reality, they're actually shifting risk to U.S. taxpayers. And here, actually, I think economic history shows an alternative, because economic history is full of examples, and this is, the Federalist Society is legal experts. Economic history is full of examples of the use of transparent state contingent contracting that can be a crucial source of financial stability. And I know that there are lots of issues, lots of problems with COCOs, but I think it's important to continue studying efficient design to see if some of the problems we've observed with COCOs can be addressed, because in a lot of cases in history, we see banking contracts that include some contingent bail-ins, basically, and bail-ins before things get really ugly.
I'm going to turn to Aaron and Randy for this one. Is the Dodd-Frank established its Title II resolution authority. What are your views on that? It's probably one of the most, other than the Bureau, the most controversial piece of our financial regulatory system right now. There's been a real debate on whether or not that's going to provide market discipline and address our too big to fail system. I'm curious, I'll start with Aaron, then move to Randy. Just for sake of time, if you could just be brief, what's your sense? Is Title II actually going to work? Does it impose some market discipline in our financial system?
So first off, I mean, Randy has tremendous technical expertise on this. Broadly speaking, I would say, yes, it will work if people will trust it. At the end of the day, we built a system that I think is pretty resilient to handle failures. But the real question is, will regulators have the courage when time strikes to operate it? I'm highly optimistic about the system working. I'm less confident that it will be employed.
Randy?
So I had to distinguish Title II from resolution plan, because as you know, the resolution plans are supposed to be executed under the bankruptcy code. Right. And only if the bankruptcy code fails, or they fail under the bankruptcy code, would you invoke Title II. So Title II, and I think that's a purpose. I think that when Title II and Dodd-Frank were passed, we didn't really understand the nature of bank failures. Yes, we knew there were runs on banks, but we didn't really understand the too big to fail problem. I don't think we understood what the how to restructure things to find a solution. I think we've learned a lot in the last 10 years. I do think that the resolution plans of the largest banks are quite resilient. They have a lot of loss absorbing capacity, about 5 times more than they had in 2008. That's now been restructured so that it's subordinate to the claims of short-term creditors. And that means that there's a lot of loss absorbing capacity without calling on the taxpayer to bail them out, that can absorb losses before the people who might have an run would lose a penny. So I think that the resolution plans are very effective. If they're effective, Title II should not be needed. But as Darren says, we'll have to see how it works in the real world. But I think that the structure is to create an alternative, because I think the government authorities in 2008 felt like they had only 2 choices. One was to watch the system melt down and risk having us living in tents and eating out of tin cans, and the other was to bail out the institutions. And so they picked the lesser of 2 evils, bailing out the institutions. The hope is that these resolution plans and the higher capital, higher liquidity requirements, and higher total loss absorbing capacity, or TLAC, will make a big difference, so that the authorities have a third choice there instead of those 2 dilemma choices. And that's the big hope. And I guess I'm confident that they will work. I guess I'll not express skepticism to Eric. I'll hope that the authorities have the backbone to have the system work as it's been designed.
Yeah. Well, I'm going to end with an issue I think of interest to everybody, which is the role of kind of due process in financial regulation. This is something we've seen over the last 4 years. Financial regulators have taken a variety of steps, and this is the question I'm going to ask you, Kathy, is there's been a lot of debate about what the proper line is on rules for financial services companies, on when financial regulation should be a rule done by staff through guidance, as opposed to when it should be and when it has to be binding. And I'd love to, you've issued some guidance on this when you were director. Give us a sense of, first of all, what your thinking is about the role of guidance in financial regulation, and also how it plays into kind of a management of an agency. You have a lot of employees that you have to oversee at a place like the Bureau. Having them empowered to provide guidance certainly can be helpful for the regulatory process, but at the same time, trying to make sure rules are consistently applied has got to be a real challenge in that environment. So I'm curious to know a little bit more about how you're thinking about your guidance on guidance and its role in your overall management of the CFPB.
I think it was a very important step to acknowledge not just how useful that guidance is, to your point, in managing the agency and setting, again, what the policy direction is for interpretation that can apply itself in examination, in specific questions that come in from regulated entities about interpretation. But really, it's about being transparent. And so the Administrative Procedures Act is, frankly, again, talk about something that has stood the test of time and outlines due process, takes into account where there might be emergency situations, so to speak, and what comment periods can look like. But it is important to actually have that discussion back and forth. The agency is not the font of all information, and it's really that signaling to say, yes, this is an area where there is need for rulemaking. There is a need for all of the entities, to understand how the rule applies to them. But guidance is necessary, and so that signal of putting out a rulemaking on guidance, which I know seems very bureaucratic, but it is about being transparent about how guidance is applied, when it's useful, why it's important to provide specific examples for different entities down the line. And it's also a signal to other agencies. I mean, as we talked about, this is about effective governance. This is about effectively carrying out what is an important statutory mission for any agency. And it's even, the rulemaking process is a signal to other agencies that have a stake in, how a law is interpreted, a stake in how it's implemented in the financial system. And in some respects, the rulemaking process that has informally, grown up amongst the financial regulators is, again, a way to, have that more coherent message to the industry about how they're going to be regulated, and the opportunity to have some debate amongst the agencies about how to look at and interpret certain things. So I do think that whole process is really important in terms of carrying out authorities. And I would, there are things that can be at cross purposes here across agencies without this kind of discipline. There are things that, the CFPB might feel very strongly about, but not even know the history at HUD or at other places. So again, that opportunity to really have a conversation about it. And so at the Bureau, we put out a lot of policy under my leadership that was explaining, and we took comment on things we weren't even required necessarily to take comment on because it was guidance, but it was important in terms of signaling. It is important in terms of trying to make sure that all of the stakeholders understand. It was important to me that consumer advocates saw a policy in writing that is issued and not something that is a behind the scenes conversation that an examiner has with an examined entity. So all of those things are things that I think really do bring about better governance, and where that rulemaking on guidance played an important role to clarify what is legally binding and what is really a signal about the agency's priorities and the agency's approach.
Tyler, I'm going to turn to you as a kind of follow up on this to talk a little bit more about the economics of this. The U.S. regulatory system has become pretty complex. There are thousands and thousands of pages of regulation right now. What's your view about the impact of that amount of kind of regulation and complexity for both the effective regulation of our system, but also in the fostering of a really dynamic financial sector here. Other countries have a different approach. They use more principles-based. From an economic perspective, is there a difference? Is there a cost to using this, or is this part of the rule of law that we should accept?
Well, so as I noted earlier, I mean the cost has differential impact on financial institutions of different scales, because those costs of compliance can be averaged over a much bigger volume of lending for larger institutions than for smaller institutions. So you're changing the composition of lending because you're sort of crowding out lending by firms that tend to lend to make smaller loans which are also more adversely impacted by a rise in average costs because the margins suffer a bigger reduction. So you're changing the composition of lending by disproportionately impacting firms who disproportionately lend to smaller, medium-sized enterprises. I think there is evidence that providing opportunities for institutions to obtain partial regulatory relief by adhering to just a simpler but higher capital ratio can be more efficient. And this was, again, something that was introduced in the 2018 law to help, and it can further help attenuate systemic risk by facilitating diversification in the system. So financial institutions can maintain higher capital ratios without killing portfolio diversification across banks.
Okay, we just have a few minutes left, so I'm going to just end with kind of a round robin here, a little old John McLaughlin move, which will be, if there's one reform you would recommend, what's the one reform for the financial regulatory system that the U.S. Congress should adopt tomorrow? And I'll start off with Aaron, because I'm sure he has 6. So
we should immediately require real-time funds availability for all consumers. This legislation has already been proposed, waiting for the Federal Reserve to build a system that they promise in 3 years will be equal to what England did in 2008, imposes tens of billions of dollars of hardships on working Americans, and it ought to be a small c conservative principle that people should have access to their own money immediately.
Randy?
So I think the thing that has not really gotten as much attention as it should is there's been a lot of attention on things that Kathy talked about in terms of regulation guidance and so forth, but there's a lot of the oversight of banks is done in the name of supervision, which is by a large body of staff doing examinations, and they need to have a fair degree of discretion in order to carry out their activities appropriately. But I think there could be more accountability. There could be more standards about how that supervisory discretion is exercised, and more after the fact due process. It's very difficult, I think, to require every time a supervisor wants to take an action to do sort of a public notice and comment. But I think that by the same token, after decisions have been made, I think it would be useful to have some kind of a due process, a procedure afterward to really evaluate whether the way it's been carried out and the standards applied are consistent with the rule of law and our general principles of due process.
Kathy?
I'm going to take this opportunity to plug the task force report. Of course, the CFPB put out a 1-year effort that really looked at the next 10 years of financial regulation. And I'll say, too, it was a huge challenge in Dodd-Frank to even just put together what was there. All of the consumer finance laws that were thrown at the Bureau and how they interact with each other and what impact they have on the marketplace. Now that we're looking at all of the changes that we've talked about and the last panel talked about with fintech, that is a huge undertaking to think about how to modernize that. And so there are some great ideas in that task force report that everyone should take a look at.
That's great. Tyler?
Incredibly end bailouts. I don't think we've yet done that. And so I think some introduction of a dynamically credible contingent capital requirement is perhaps a path forward. But as I said, bigger picture and bailouts.
Terrific. Well, I think each of you have given us a topic for a future FedSoc panel on. So I want to thank everybody for joining us today. I really appreciate you taking the time out to share your thoughts and wisdom with us. It's been a fantastic discussion. Now I think I'm going to turn it over to Dean, I think, for the closeout here.
Well, thank you, Andrew Ullman, our moderator today, for hosting after assembling today's event. Thanks also on behalf of the Federal Society, and my personal thanks to our many panelists, and also to our audience for your participation during today's conference. Please do join us now in the lounge to network with other participants and attendees and some of the speakers. To join the lounge, the digital team will send an alert which will appear in the top right-hand corner of your screen. You click on the alert, move to the lounge, and then click on one of the empty seats at any table. A reminder, you'll need to turn on your camera and your microphone when you get to the lounge. We'll keep that lounge open for the next hour or so, as long as people hang out. I hope to see you there. Thank you for participating again, and with that, we are adjourned. See you in the lounge.